This is a really inspiring event. I'm delighted to be here. I would like to start by going back a few years. I've been very lucky. There have been several times where I could have gone this way or this way, and if on 7 or 8 occasions I had picked a different direction, no prize. So maybe the most important time was when I was about 2 years through my undergraduate studies, and I happened upon, I caught the interest of what I regard as my mentor, who steered me towards a PhD, and ever since I've done what I love to do. Nothing is better than finding something you love to do, and people are willing to pay you for doing so. Now, maybe the most important time was about 2 years after I graduated with my PhD. I went back to Bergen, Norway, to teach at the business school, and I arranged to get someone I had met 2 years into my graduate school. I invited him, his name was Prescott, to spend a year at the business school in Bergen. And then in the spring of 1975, we wrote a paper that ended up being titled Rules versus Discretion, the Timing Consistency of Optimal Government Policy. I remember going to Cambridge, Massachusetts to present it at the conference in May of 1975, and I barely got beyond the title and all hell broke loose. Everyone was convinced that this paper contains serious errors. Now, I was pretty confident that there were no errors, but you're never sure, so this could be good news or bad news. If there was an error, bad news. If no error, the fact that everyone thought that there must have been a mistake, that's sometimes a sign that there's been an important finding. Now, this was a paper that was cited by the committee in Stockholm as a basis for the prize. Almost 30 years later, that's how long it takes for that kind of thing to happen. Now, for years and years, I wouldn't normally talk about the findings in that paper. Basically because, well, you get a little tired of talking about the same stuff over and over again. You're more excited about your most recent research, etc. But then, starting in around 2008, suddenly the situation arose where it seemed to be the thing to talk about. And since then, in my public speeches, which I get to do from time to time, actually starting with a keynote address in Lima, Peru, I decided this is what I should focus on because it seems so relevant to the current situation. Now, let me just try to give you an intuition of what the finding was. Imagine a very benign, the most ideal policy situation. Imagine there's a benign policymaker who somehow tries to maximize, to optimize welfare for its citizens. Imagine then that one could even come up with a mathematical expression for the citizens' welfare or preferences today and indefinitely into the future. So the best policy, the optimal policy, would be that a policy, let's say a plan for what to do into the future, that would be best for people's welfare. Now, the problem with that policy is that it would in general be inconsistent over time. So imagine, for example, that 5 years after we're chugging along, carrying out this policy, everything is going well, or there could be an unexpected crisis coming up, but still the plan has a specification for what to do even in a crisis. Now, suppose some hotshot guy in the office of the policymaker decides to recalculate the optimal policy, just in case. Nothing has changed. It's still the same welfare function, etc. He would discover that from now on it's optimal to do something completely different. What's the reason for that? Well, the reason is that lots of economic decisions depend crucially on the policy environment in the future. So if you're thinking, if a business person or owner is thinking about building a new factory costing millions or maybe tens of millions or hundreds of millions of dollars even, this is a huge cost today, but the returns to make up for that cost, the returns come for years into the future, maybe 5, 10, 15 years into the future. Lots of things could happen during those 5, 10, 15 years, including the government might change its policy. What matters are the returns after taxes. What if the tax rate were to go up from 30 to 50%, let's say? Or in some countries one might be worried about a business being confiscated, nationalized. I'm a Norwegian. In Spain, you've heard of that kind of possibility, I'm sure. So businesses would they make up, they form an opinion about the future policy environment, and they base their current decisions on that. So the point is, the future policy affects behavior today, or today and tomorrow. So when this hotshot guy in a policymaker's office recalculated the policy, well, the decisions over the past 5 years have already been made. The continuation of the policy, the original policy, took into account the effect it had or would have on behavior during those first 5 years, but those decisions have already been made. And so if you recalculate, taking as given what has happened so far, you'll come up with a completely different policy. For example, there could be the temptation to tax capital that has already been built, factories, machines, office buildings, and so on. more heavily, because they probably won't shut down even if that happens. Especially if if the government can make the case that now there's an emergency, we need more revenue. Now, where is that kind of temptation likely to hit the hardest? Well, the example I gave you about taxing already built capital harder, that's a good example. Another is, for example, Latin American countries for a while were experts in getting rid of its government debt by running a hyperinflation, as we call it, extremely high inflation rates. If you're holding, let's say, $1,000 bond and inflation is like hundreds of percent per year for a while, the value of those bonds would go down almost to zero in a short period of time. Of course, at great pain for the people holding them, say pensioners who would depend on them for expenditures in old age. So, to me, that framework is a useful framework to think about much of what happens in the world. In some countries, good things. In some countries, not so good things. Now, let me start with a kind of a picture of what's going on in the world. This is GDP per capita, which is basically also income per capita in various nations. I know, of course, that GDP is not necessarily the most important for people's welfare. There are other things in life. For example, in Spain, it seems that life is better than GDP would suggest. At least that's my opinion, and the reason I come to Spain as often as I can. In some countries, things could be worse than GDP suggests. There could be a lot of income inequality, and so that could mean that many people are not doing nearly as well as GDP would suggest. But this is a readily available measure. There are some interesting aspects of these curves. By the way, modesty kept me from including Norway in the picture. Now, notice that some countries grow quite fast. I should warn you, by the way, because this is not on proportional scale, a certain steepness high up in the picture represents a much lower growth rate than the same steepness further down. For example, I included a couple of recent countries, Kazakhstan and Azerbaijan, at the very bottom, and they have grown very fast in recent years. Argentina is an example. The blue line that starts about $7,000 or $8,000 a year GDP per capita, and it hasn't moved much up from that, or at least not since the early 80s. Argentina is a good example of a country that just cannot resist the temptation of trying to do what they think is best in the very short run and not pay attention to the long run. So that's how this time inconsistency is likely to show up in practice. There's likely to be political pressure to do something in the very short run. Politicians are sometimes somewhat nearsighted, and it's hard to keep them in that country from choosing a plan that or revising the plan all the time. I think of Argentina as a prime example. In order to prop up confidence in Argentina after a very bad decade, the 80s, the so-called lost decade, with an example of a hyperinflation, as I mentioned, in the late 80s. The incoming president, Menem, decided to tie the peso to the dollar 1-for-1, and that seemed to work for a while. But then in the what they forgot was you also need to make sure the fiscal system, the taxing the government expenditures, build up of government debt, let's say, you needed to fix that as well. So then after a few years, the provinces started to borrow to a large extent to pay for their expenditures. Then it turned out they were not in a position to pay back their debt, and then they came running to the government for the federal government to bail them out. Remember, I was talking about Argentina, not about Spain. So Argentina had a Great Depression in the 80s, and then after 8 years of reasonably high growth under Menem, under the currency board as it was called, another Great Depression that started in 1998. And in Argentina, because of this lack of credibility of the nation, they're always doing weird things in the short run. The capital stock per working age person is no higher today than it was in 1982. Now, Argentina seemingly has done fairly well in the past 2 or 3 years because of the high commodity prices. But if commodity prices were to fall, they would be in deep trouble because of the lack of investment in productive capacity. Now, I should say that a consistent policy is no guarantee that you'll be doing well. Notice that I was talking about optimal policy, or let's translate that to good policy. You see towards the bottom of the picture, starting at the very bottom is a curve for China. China gets a lot of attention these days because its total GDP has grown quite a bit, and so it's projected to become, in that sense, the biggest nation in the world in a number of years. But few people are aware, I think, or think about the fact that GDP or income per capita is quite low in China still. China is a country where you could argue policy is quite consistent, but I would also argue that policy is not very good for the long run. In China, almost all the banks are state-owned. They lend to big state-owned companies, so those companies have easy access to credit. They have easy access, or have had so far, easy access to cheap labor input. So even without much innovative activity, they're able to show profits, considerable profits. Meantime, the entrepreneurs, the people who are the innovators of the nation, those who in most growing nations would be the driving forces for the country to grow, they have a hard time getting loans to put their ideas into use. Typically they have to save up in advance and then put their ideas to use. They are biased towards more labor-intensive activities, and I'm afraid that will come back to haunt them unless they open up for more competition in the financial sector. Let me show an example that seemed to work quite well in the light of the theory I was talking about, and that's the case of Ireland. So you see in this picture, this is a collection of European countries, Denmark, Great Britain, Germany, typically at the top, and then you have more towards the bottom. In the 70s, 80s, in this picture, Greece, Ireland, and Spain. In the early 90s, Ireland decided there just weren't enough factories for potentially skillful workforce. They have high education people, but no factories to work with, office buildings and so on. So they said, if you set up shop in Ireland, these will be your tax rate, not just next year, the year after, but all the way to 2009, removing a lot of uncertainty in that kind of decision. And it had an amazing effect. I'm not saying that was the only thing that mattered, but you can see in this picture that Ireland went from, in a short period of time, overtook everyone in this picture. Now, unfortunately, Ireland stumbled, let's say started in the mid-2000, around 2005, banks started providing too much credit for construction, etc. And then after a lot of not so good decisions by banks, the government decided to bail them out. A terrible decision, in my opinion. So Ireland has fallen on hard times, but that doesn't take away from the effect of those decisions in the early 90s. Let me just, this is sort of a depressing picture. Africa was mentioned before. The previous two slides had the vertical axis going from 0 to 40,000 roughly. This goes from 0 to 10,000, and 10,000 only to fit in Botswana, which is one of the relative success stories in Africa. They've been better than many at managing their wealth of resources like diamonds and other minerals, but many of these countries are doing poorly, in large part because of bad institutions, lots of corruption, not even close to what I would call an optimal government policy. Very, very depressing. I'm having, for some reason I thought I had a half an hour, and I know I have only 20 minutes. I'm not sure how much I've used, but so I'll skip the example of the United States and go to just finish off talking about this example, because it's so important for to think about for Spain and for other nations. it's an example that illustrates the importance of the banking sector. I already talked about that in the context of China. In 1982, both Mexico and Chile faced the crisis because of high world interest rates, falling prices for their commodities, petroleum in the case of Mexico, copper in the case of Chile. In both nations, that type of crisis exposed big problems in the banking sector. In Chile, for example, banks accounting for half of the nation's deposits, bank deposits, faced a severe liquidity crisis. The government took over, and within 3 years they had gotten rid of the banks that were clearly failing, and then within 3 years reprivatized the banking sector. They instituted a regulatory environment to avoid mismanagement of the banks, and pretty quickly banks or credit was available at market interest rates, and Chile started growing. The initial cost was high. As you can see in the picture, both countries start like an index at 100. In the first 2 years, Chile's GDP dropped by 15%. That was the cost of making that decision, you might say. But then Chile started growing, and you can, as demonstrated in that picture. Meantime, Mexico, they were in a similar position, but the government, after they took over the banks, they did not reprivatize until the early 90s. So, government officials trying to maintain employment and output lent to some big companies. You can imagine bureaucrats deciding, well, you get a loan, but you don't get a loan. And if you think government bureaucrats necessarily are the ones who know best where the best users of funds are, you probably also believe in Santa Claus. And you can see the effect on Mexico. It pretty much stumbled along at more or less unchanged level. The initial cost was lower. The drop in GDP was not nearly as high as it was in Chile, but very little growth in the future. Now, I've talked about these issues because I think some of them are relevant to the situation in Spain. I think there are lots of things you can learn from good or bad policies in other nations. Spain, I admit I don't follow the economy that closely. I had a conversation with a good friend of mine, Javier Diaz, whom I've known for 20 years since he was a graduate student at the University of Minnesota. And his view is Spain is now in a better situation than they were in 2007. How is that possible? Well, the argument is Spain was facing lots of problems in 2007. People just didn't know about it. Now we know what most of the problems were, and now there's the opportunity to do something about it. And so if the right things are done, or reasonable policies are carried out, then Spain should do well in the long run. Thank you very much.